Natural disasters and climate-related crises are increasing in frequency and severity, with the most vulnerable nations losing over 2% of their GDP annually to such shocks. Such events force governments to redirect scarce resources from long-term priorities, like health and education, toward emergency relief, perpetuating a cycle where crisis response crowds out sustainable development. This is why Bridgetown 3.0 is calling to reform the international financial architecture into one that is more equitable and fit for purpose, with shock-proofing economies being a key pillar. However, investment in resilience remains far below what's needed and is constrained by two major gaps. Firstly, a protection gap, which highlights that 90% of natural disaster losses in developing economies are uninsured. And secondly, a climate finance gap, indicating that by 2035 developing countries will need an annual investment of $1.3 trillion. Together, the protection and climate finance gaps represent both a major vulnerability for governments and a missed opportunity to unlock much-needed investment in building resilient infrastructure in developing countries. And a key part of achieving this is by scaling insurance. Insurance is a vital but underused instrument to help close both gaps, with the Bridgetown initiative estimating that it could unlock $200 million in climate finance annually. While it is often viewed merely as post-disaster financing, insurance is in fact a vital enabler of resilience, development, and growth. By transferring risk and providing predictable, pre-arranged funding that is approved in advance and released automatically when specific, pre-agreed triggers are met, insurance enables governments and businesses to plan, invest, and rebuild. It is a critical part of securing investment by ensuring investors' assets and revenues are safeguarded, as well as lowering borrowing costs and stabilizing public finances, acting as a safety net both before and after a disaster happens. In Grenada, comprehensive insurance coverage secured $55.6 million in payouts after Hurricane Beryl, while St. Vincent and the Grenadines' limited coverage resulted in only $1.9 million, despite both countries losing significant amounts of their GDP. Insurance is not a silver bullet, but as part of a layered risk management strategy alongside catastrophe bonds, contingent credit lines, and national reserves, it provides a safety net that sustains public finances and development. However, to achieve this, the Bridgetown Initiative recommends 4 action areas. Firstly, governments must quantify protection gaps and adopt integrated disaster risk management strategies. Secondly, multilateral development banks should integrate pre-arranged finance into lending and investment frameworks. Thirdly, insurers should expand risk reduction incentives while increasing investment in developing economies. And fourthly, regulators must design flexible regulations that align with international standards. It's time to move beyond reactive bailouts and integrate insurance as a core component of climate resilience. To find out more, visit bridgetown-initiative.org.